The topic for tonight would be PAS 23, the standards governing borrowing costs. PAS 23 class is actually one of the simplest standards, one of the easiest standards to understand. Basically, PAS 23 will provide us with the rules on how we are going to treat borrowing costs. So for you to understand what is the objective for tonight class, you should have an idea on what borrowing costs are. The simplest way to understand borrowing costs class is that they are simply your interest expense. You borrow money and the corresponding interest that you will have to pay as a result of the borrowed funds would be our borrowing cost or our cost of borrowings. So what then would be the treatment of our borrowing costs? As I mentioned earlier, you can just consider it as an interest expense. So definitely one possible treatment for borrowing costs or for interest costs would be as an expense. And in that regard, the treatment for borrowing costs would not be very complicated. But there's another possible treatment class for borrowing costs, and that is borrowing costs may be considered as capitalizable costs. Capitalizable meaning they would be included in the cost of the asset. They would be capitalized as part of the cost and carrying amount of the asset. I normally tell students class that their default classification or treatment for interest should be as an expense. If you cannot remember the general rule and the exemptions, I'd rather you forget class that it is possible for interest to be capitalized than you forgetting that interest should be expensed. You will encounter a lot of problems class in which interest should be reported as an expense. Even though if you read the first paragraph of PAS 23 class, it tells you that borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset will form part of the cost of that asset. Then it continues that other borrowing costs are recognized as an expense. So by reading that paragraph class, it will give us an impression that the default treatment then for interest cost or for borrowing cost is that it is to be capitalized. And it should only be expense if it is not to be capitalized. And strictly speaking, class, that is true. But to aid you, class, to make your recollection of the rules easier, class, I'd rather the expense treatment stick to your minds instead of the capitalization treatment. Again, when we say capitalize, the expenditure will be included as part of the cost of an asset. I prefer that you remember interest to be expense class instead of being capitalized because in most problems that you will encounter class, the classification for interest would be that it is to be expensed. Ignore the fact class that PAS 23 tells us first that if it is related to the construction or production of a qualifying asset, it should be capitalized and it will only be expensed if it will not qualify the capitalization requirement. If you'll observe class, it says here directly attributable to the acquisition, construction, or production. So it makes sense class why it can be capitalized because they are similarly situated as those that we consider as directly attributable costs as discussed in PAS 2 and PAS 16. You have to understand that the occurrence of interest being capitalized is far more unlikely than it being reported as an expense. If you read the provision carefully, class, it tells you that borrowing cost will only be capitalized if it pertains to a qualifying asset. So what this should tell us is that the possibility of interest being capitalized will exist only if we are dealing with a qualifying asset. And if you read the definition of terms class, qualifying assets are those that necessarily takes a substantial period of time to get ready for its intended use or sale. Now, if you'll recall our directly attributable costs class, they are our costs that are necessary to bring the asset to its intended use, location, and condition. So here we are in PAS 23 class, we are dealing with an asset that normally takes a long period of time before it becomes ready for its intended use or sale. And that is why it will be understandable why interest would be considered as necessary. The main argument I would offer students class why they should just remember interest as being expense, because almost always interest is not necessary for the acquisition or construction of an asset. You do not have to borrow money for you to buy an asset. The acquisition of an asset does not care on whether or not you finance the acquisition by your own money or by money provided by others. But if we are now talking about qualifying assets class, if they normally take a substantial amount of time before they become ready for their intended use or sale class, the interest on the money that you will use class to acquire or construct the qualifying asset becomes relevant now. Since by the very nature of the asset class, it can only be acquired or constructed after a substantial period of time, the segregation of money that will be used for the construction or acquisition of a qualifying asset becomes a necessary part for the acquisition or construction of the asset. Since qualifying assets will take a substantial amount of time before they become ready for their intended use or sale, then the interest that will accrue from the funds that are going to be used for the acquisition or construction of the asset becomes a necessary component or ingredient in the construction or acquisition of the asset. And this is why I would say that this would be an exemption as to the treatment of your interest. Again, I'd rather students remember that our general rule for interest would be that it should be reported as an expense, and that we will just treat the capitalization of interest on qualifying assets as our exemption. Because normally, interest is not involved in the acquisition of assets class. But because qualifying assets require a substantial amount of time before they become ready for their intended use or sale, it now becomes understandable that the need to set aside funds for the construction and acquisition of the asset and the corresponding interest on such amounts will be considered as a necessary step or ingredient in the acquisition of the asset. So again, our general rule is that interest is to be expensed. Especially in inventory problems class, you will encounter a lot of inventory problems in which you will be asked whether or not the interest on borrowings to acquire inventory would be inventoriable or will be included in the cost of the inventory. Our answer would be no, because interest is not a necessary cost. It's not a directly attributable cost in the acquisition of inventories. But if we are now talking about a qualifying asset class, the interest on the funds that we set aside for the construction and acquisition of a qualifying asset can now be considered as a necessary cost, can now be considered as a directly attributable cost, and can therefore be considered as a capitalizable cost, meaning it will be included in the cost of the related qualifying asset. So again, general rule, interest is expensed. But if we're talking about a qualifying asset, that would be the only time that interest may be considered as capitalizable, that it will be considered as part of the cost of an asset. So going back to the scope of the of PAS 23 class, as I've mentioned earlier, PAS 23 is to be applied for the treatment or accounting for borrowing cost. Now, a commonly overlooked fact class that the costs that we are dealing here class should only pertain to borrowing costs. So even though there may be costs that are imputed on our equity instruments class from our shares, whether common or preferred, the periodic payments, the dividends that we will pay as a consequence of the equity instruments, as a consequence of the shares class, are not within the scope of PAS 23, meaning we will not be capitalizing the dividends that we will be paying to our equity shareholders class. The scope of PAS 23 are limited only to borrowings, meaning liabilities. If our obligation from the use of funds arise from a liability, then that will be considered as part of our borrowing cost. But if it arises from a purely equity arrangement class, not as a liability, then payments to those equity holders will not be part of our borrowing costs. However, there are a few items that are expressly exempted from capitalization of borrowing cost class. As I've said earlier class, our general rule is that interest will be expensed. Exemption would be interest on funds used for qualifying assets. But there is an exemption to the exemption class, meaning even though the borrowing cost arises from a qualifying asset class, it would still be expensed if the qualifying asset is to be measured at fair value, such as your biological assets, which is covered by PAS 41, which we will discuss next. So again, general rule, interest is expense. Exemption, interest on qualifying assets may be capitalized. Exemption to the exemption, interest on qualifying assets measured at fair value are not to be capitalized pursuant to the requirements of PAS 23. So please remember, class, we can capitalize interest if it's from a qualifying asset, but it's another story if the qualifying asset is to be measured at fair value. Another instance in which the provisions of PAS 23 are not to be applied is with regard to inventories that are manufactured or otherwise produced in large quantities on a repetitive basis. A good example for this one, class, would be with regard to your condominium units, class. In the construction of your condominium units, class, the interest on the funds used to construct the condominium units may be capitalized. Take note that condominium units will be considered as inventories because they are primarily held for sale. But your condominium units, class, are not manufactured or not constructed in large quantities and on a repetitive basis. Almost every construction project, class, would be unique, and in that instance, capitalization of your interest may be allowed. So if you're dealing with inventories, class, that are manufactured or produced in large quantities and on a repetitive basis, there should be no capitalization of interest, and that can make sense, class, because if the inventories that you are producing, class, are being produced in large quantities and on a repetitive basis, class, that means the use of funds and the resulting interest thereto is not a necessary component in the production process. The fact that they are produced in large quantities and on a repetitive basis, class, would suggest that the manner of financing the production of those inventories is not relevant in the production or manufacturing process.